Would you like to invest in a company that has one of the best-selling products in the world? Like the idea of owning a slice of a business that practically prints money? Want to collect a market-smashing yield of near 6% while you own that slice? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is selling life-improving and life-saving pharmaceutical drugs to millions of people around the world. This company may as well print money, with its top-selling drug doing almost $15 billion in sales last year. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of AbbVie Inc., which appear to be trading at a significant discount today. AbbVie Inc., stock ticker ABBV, is a global pharmaceutical company with a particular focus on immunology and oncology. With a corporate history that can be traced back to 1888, AbbVie is now a $149 billion by market cap pharmaceutical behemoth that employs almost 50,000 people and sells its products in more than 175 countries. HUMIRA, an immunosuppressive medication, is by far their largest and most important product, accounting for approximately 45% of fiscal year 2019 revenue. This drug had net revenue of almost $15 billion last fiscal year. HUMIRA has been both a blessing and a curse. On one hand, it's been an absolute blockbuster, becoming the best-selling drug in the entire world. On the other hand, it's become such a large and outsized percentage of revenue that biosimilar competition threatens to crush the company's future earnings. The dreaded patent cliff is coming, with HUMIRA's patent protection expired in Europe and expiring in 2023 in the United States. Understanding this, AbbVie has gone out of their way to protect the business through licensing deals, additional patents, R&D spending, and a huge acquisition. Regarding that last point, AbbVie just recently completed its $63 billion acquisition of Allergan plc, which greatly expanded and diversified its drug lineup. Investing in a global pharmaceutical company is a pretty straightforward proposition. You're betting on the continuation of what's already been playing out for many years. The world, quite simply, is growing larger, older, and richer. That means greater demand for and access to quality medicine. This means AbbVie should be able to continue growing its profit and dividend for many years to come. The company has already increased its dividend for 8 consecutive years. That might seem surprisingly short, but the track record is only so limited because AbbVie was spun off from legacy company Abbott Laboratories in 2013. Thus, the dividend growth track record is as long as it can be. What they may lack in length, they make up for in terms of the growth rate. The 5-year dividend growth rate is 20.9%, which is incredible. That comes on top of the juicy yield of 5.9%. It's not often that you find double-digit dividend growth paired with a yield this high. This yield, by the way, is 220 basis points higher than the stock's 5-year average yield. And while the dividend payout ratio of 103% based on trailing 12 months GAAP earnings per share looks high, that's largely because of volatile GAAP earnings that do not accurately reflect profit. Free cash flow covers the dividend almost twice over, which indicates a very safe dividend. Looking at business growth, AbbVie grew its revenue from $18.790 billion in fiscal year 2013 to $33.266 billion in fiscal year 2019. That's a compound annual growth rate of 9.99%. Very impressive. And this result does not yet include Allergan, as that transaction didn't close until May 2020. I ordinarily use 10 years of growth data in my analyses. However, AbbVie didn't become an independent company until 2013, so I'm basically going back to inception here. Earnings per share increased from $2.56 to $5.28 over this period, which is a compound annual growth rate of 12.82%. Again, very impressive. Modest buybacks helped to propel some of this excess bottom line growth. Admittedly, AbbVie's GAAP results have been lumpy over the last few years, which makes it difficult to pinpoint growth. But taking a high-level, long-term view of the company shows a captivating growth curve. Looking forward, CFRA believes that AbbVie will compound its earnings per share at an annual rate of 6% over the next 3 years. That would be about half of what the business has done over the last decade. CFRA notes biosimilar competition for HUMIRA as the key issue, which will start to ramp up markedly in 2023 when US competition comes online. The Allergan acquisition offsets this concern to a degree. There's also the robust pipeline. AbbVie had 60 compounds or indications in clinical development at the end of 2019. The last few years have been a golden era for AbbVie. I wouldn't extrapolate this kind of growth out indefinitely. However, I do applaud AbbVie for doing all they can to protect the business model generally and HUMIRA specifically. While I would have preferred to see strategic bolt-on acquisitions toward this end, which would have avoided adding so much debt to the balance sheet, the Allergan move goes a long way toward cushioning the upcoming blow. I think AbbVie felt like it had to move fast and go big. I do find it curious that CFRA is expecting such a dramatic slowdown in growth over the next few years. HUMIRA still has a nice runway in front of it. 2023 is when turbulence starts to seriously enter the picture, but even then, it's not like HUMIRA sales will just totally disappear. In the end, mid-single digit bottom line growth rate is more than enough to fund similar dividend growth, and that's very appealing when paired with a yield near 6%. And they could very well do even better than that. Moving over to the balance sheet, AbbVie is heavily indebted. In my opinion, this is the weakest area of the business. The company started off in 2013 with plenty of debt, and they haven't improved the situation in recent years. To the contrary, the Allergan acquisition creates a larger and more diversified business with much more cash flow, but it does so at the expense of even more debt. There's no long-term debt to equity ratio here because of the high amount of treasury stock creating negative common equity. However, the interest coverage ratio came in at under 5 last fiscal year, which is mildly concerning. Credit ratings are as follows: Moody's Baa2, Standard & Poor's BBB+. It's not a terrible balance sheet, but it could certainly be improved. Profitability, as one would expect, is highly robust. The best-selling drug in the world will allow for that. Over the last 5 years, AbbVie has averaged annual net margin of 21.03%. Return on equity is not applicable due to negative common equity. There's really a lot to like about this business. It's a world-class pharmaceutical company offering a juicy yield, and with strong competitive advantages like patent protection, IP, R&D, and global scale, the company is positioned about as well as it can be. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Competition will soon become even more fierce when HUMIRA comes off patent in the US in 2023. The upcoming patent cliff for HUMIRA due to product concentration is a major near-term risk. While AbbVie has one of the biggest pipelines out there, compounds that fail to go to market can be major setbacks. The balance sheet is heavily indebted, creating liquidity risk and limiting future acquisition opportunities. Lastly, there's integration risk with the massive Allergan acquisition. The risks are clear, but so is the value. With the stock down 20% from its 52-week high, I think the valuation is quite attractive right now. The price-to-earnings ratio of 17.7 compares very favorably to both the broader market and the stock's own 5-year average price-to-earnings ratio of 27.4. However, lumpy GAAP earnings have skewed the price-to-earnings ratio, but every other basic valuation metric shows a depressed valuation. We can look at cash flow as an example. Price-to-cash flow ratio is sitting at 8.3, which is well off the stock's 3-year average price-to-cash flow ratio of 13.4. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate due to the high yield and a long-term dividend growth rate of 4%. This dividend growth rate might look shockingly low when compared to what AbbVie has done since inception, but we have to keep in mind that the golden goose, that is HUMIRA, will be laying less golden eggs. That's just a matter of fact, and I think investors will have to moderate their expectations. This is a very cautious valuation model which is accounting for the heavy debt load, additional biosimilar competition, and merger integration risk. AbbVie could do much better than this over the long run, but I'd rather err on the side of caution with so many moving parts. This dividend discount model analysis gives me a fair value of $122.72. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all of the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates AbbVie as a 3-star stock with a fair value estimate of $97. CFRA rates AbbVie as a 3-star hold with a 12-month target price of $95. I came out high, which is surprising. Averaging the three numbers out gives us a final valuation of $104.91, which would indicate the stock is possibly 30% undervalued. Here's the bottom line, guys. AbbVie Inc. is a world-class pharmaceutical company that practically prints money with the best-selling drug in the world. With a market-smashing yield near 6%, a moderate payout ratio, big dividend growth, and the potential that shares are 30% undervalued, this could be one of the best long-term investments available for dividend growth investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.